Welcome back. You're still watching Informed Investor with my two guests, Mark Matthews and Shane Oliver. Mark, the second part of this entire global demystification is what the data means. The one term or the one issue that most global markets are working with right now is that of inflation. And you hear so many forms of these thrown about: WPI, CPI, core PPI. What's the key numbers to be watching at, both from the US as a region and indeed from Asia as a region, when you're trying to understand inflation trends?
Well, I think that many countries in Asia still base their prime interest rates off of the U.S. because they want to remain competitive in their exports. And so if they raise their interest rates too much and the U.S. is not, their currencies will appreciate and they won't be able to sell as many things to the U.S. or to the rest of the world, really, because the American dollar is still the reserve currency of the world. So therefore, I think that the key inflation number is still got to be that of the United States. It's also the largest economy in the world still, so that kind of makes sense. But when it does get to a certain level that the Federal Reserve is satisfied with, the next step will be for interest rates to rise there, and there will be many follow-through effects on various assets around the world, including in Asia. What's important about China is that it's growing so quickly that it is the end user of many of the things that are being produced in Asia outside of the manufactured sector. So commodities, for example, China is definitely the marginal buyer that influences the direction of those commodities. And so if China is raising its interest rates very quickly, then people tend to worry that China's growth will slow down, or if it cuts them too fast, people worry that its growth is accelerating too much. But in general, what I'd say is that China's growth is really in a sweet spot for the rest of the world right now.
Shane, post the crisis that we saw, the financial crisis that we saw, suddenly a lot of eyes became focused on US-specific data, and there is so much that comes out from that particular economy and market. What would you say are the 2 or 3 key things you watch out for? For example, we look a lot at what happens with jobless claims. We look at what kind of consumer data is generated from there. What would you say someone sitting in a whole other market should track in terms of important data points coming from the US as a market?
Well, I think there's 2 pieces of monthly data which are the most important figures coming out of the US. The first one is the non-farm payrolls figures, which are released on the first Friday of each month in the US, and they give a good guide to the US labour market. And at the same time that those payroll employment figures come out, we also see the US unemployment rate. And the reason the US labour market is so important at the moment is that if the US labour market starts to grow again, then that will help household income in America and therefore help get the US economy back onto a sustainable path. The other of the 2 indicators I referred to is the ISM index, which refers to the Institute of Supply Management's monthly survey of manufacturers. It's often released around about the same time as US payroll employment figures. It provides a good guide to business conditions in the US. And recently, business conditions, as surveyed by the ISM, have been quite strong. If that remains the case, and we continue to see a pickup in US employment figures, then that would be a good sign for the US economy going forward. So those figures are released monthly, and they're released towards the start of each month. On a weekly basis, it's also worth looking at the jobless claims figures, because they give a good short-term update on the US economy.
There is another term which has risen to the fore over the last year or so, Mark, which is QE. It started with 1 and now there's 2. And as on a lighter note, many people call the post-Japan issue, it's QE3, the gush of money that came into many emerging markets. What does QE stand for, and why is it so important for liquidity issues into markets like ours?
QE stands for quantitative easing, and it's an economic term which refers to when a central bank, in this case the Federal Reserve, is buying bonds in the market to take those bonds out of the system in exchange for cash. So it's injecting cash into the system, and that creates a lot of liquidity. And it also, by buying the bonds, keeps their yields low, and low yields are also thought to be something that encourages economic growth.
These are the terms that have more watertight descriptions to them, but what about the ones with rougher edges that we tend to club together and call a trend? For example, on the concept of flows, where we try and track what's happening with emerging market flows across many markets and then reach a conclusion about what kind of inflows or outflows one specific market has. How would you rate those trends, and how important is tracking these flows in order to understand both global equities and your own market?
Well, like I said earlier, the absence of a very developed, sophisticated investor base in many of the emerging markets, for example India, means that foreign institutional investors, what they do has greater significance than frankly it probably should. And the way that a lot of people like to keep track of what those foreign institutional investors are doing is by monitoring fund flows. So you can do that either by looking at data which is disclosed from the stock exchange, because many stock exchanges in Asia do provide on a daily basis the net buying and selling of local investors and to foreign investors. Or there are some companies which specialize in gathering data of foreign funds. So they'll see foreign funds will tell them the inflows they've had into people buying their emerging market funds every week, and then these companies will amalgamate all of that data to show a trend in purchases of emerging market funds around the world. And generally speaking, these fund flows do have trends.
Shane, Mark made that point about flows, but there's another thread that people tend to link a lot of markets with, which is weekly trends. For example, if we see all Asian markets rising on a weekly basis, we tend to submit that as the fact that Asia is now beginning to outperform or underperform, as the case might be. Can those generalizations be made in terms of equity market performances across different parts of the world, and that they are moving in the same direction or in different directions?
Share markets around the world seem to go through these phases where everyone is feeling happy to take on risk. Investors are putting their money into markets. They all tend to rise. And then, of course, a few weeks later or a few months later, they all come back down again in some sort of correlated pattern. That correlation is not perfect, but generally speaking, you find that when the Asian markets are rising, most of them tend to be rising, albeit to different degrees. And that's at the same time that the US share market's also rising, and likewise markets across Europe and Latin America and elsewhere. So, and then of course when they fall, they all tend to fall together. So I think it is fair to say that markets have become more correlated in recent times.
That's a good point. Let's take a break on that note. When we come back, maybe we'll add a little bit of history to this conversation and talk about the correlations between markets, X of all these terms, and what that has pointed to in the past.